Mr. Bezos, U.S. credit card debt has just surpassed $1.3 trillion, the highest level in American history. From your perspective, what does this number really tell us about the current financial health of American households?
Look, when you see US credit card debt hitting $1.3 trillion, you're not just looking at a big number, you're looking at a signal. It's like a warning light on the dashboard of a very large, very complicated car. And that car is the American household. What this number really tells us is that a lot of families aren't using credit cards for convenience anymore. They're using them to survive. People swipe because groceries cost more, rent costs more, cars cost more, and interest rates are higher than anything we've seen in 2 decades. So debt isn't growing because Americans suddenly became irresponsible. It's growing because the cost of living has outrun their income. Another thing this number tells us is that the financial cushion people used to rely on is disappearing. Savings built up during the pandemic, most of it is gone. Wages, they're rising, but not fast enough to keep up. And when people use credit cards to fill the gap, they're basically renting money at 25% to 29% interest. That's not sustainable. Now, from a long-term perspective, rising credit card debt also reflects a deeper structural issue. The American economic engine relies heavily on consumer spending. When that spending comes from borrowed money, you get fragility. It doesn't break right away, but the system becomes more sensitive to shocks, job losses, rate hikes, unexpected expenses. And here's the most important point. Debt like this creates a psychological burden. When people feel financially trapped, they stop taking risks. They stop investing in themselves. They delay major life decisions. That eventually slows innovation and slows the economy. So what does $1.3 trillion really mean? It means Americans are working harder than ever, but the system is not working for them at the same speed. And unless incomes rise or interest rates fall, this pressure doesn't just stay on households, it spreads into the broader economy. That's when a debt problem becomes a real crisis.
Mr. Bezos, many Americans are now paying credit card interest rates of 25 to 29% levels we haven't seen in decades. From your viewpoint, how does this high interest environment change the way households make financial decisions, and what long term risks does it create for the U.S. economy?
When credit card interest rates jump to 25 or 29%, the math changes in a very real way. At those levels, debt isn't just expensive, it becomes a drag on a person's entire financial life. You're not borrowing to smooth out cash flow anymore. You're borrowing against your future and paying a premium for it. What this does to American households is pretty straightforward. It forces them into defensive mode. People stop thinking about building savings or investing and start thinking about survival. Every financial decision becomes shorter term. You delay home repairs. You hold off replacing a car. You cut back on healthy food because it costs more. You don't plan for the future when your present feels unstable. And here's the hidden cost. When people are under financial pressure, they make decisions that feel rational in the moment but are costly over time. Paying only the minimum balance is a perfect example. It feels like relief today, but it locks you into a cycle where interest grows faster than your ability to pay it off. That's how households get stuck. For the broader economy, a high interest environment creates a kind of slow-moving vulnerability. The US economy is driven by consumer spending. But if consumers are spending more on interest than on goods and services, growth slows down. It doesn't collapse suddenly, it just becomes more fragile. Small businesses also feel this. When customers cut spending, small businesses see slower revenue. Some borrow to stay afloat, but now they're borrowing at higher rates too. So you get this cascading effect where stress at the household level becomes stress at the business level. Another long-term risk is innovation. People take fewer risks when they're financially anxious. They don't start new businesses. They don't go back to school. They don't move to new cities for better jobs. And that matters because innovation thrives when people feel secure enough to take chances. So when you ask how 25, 29% rates change behavior, the short answer is they make financial life smaller. They shrink options. They shrink confidence. And over time, that shows up in the economy in ways that are subtle at first and then very obvious.
Sir, we're seeing a growing number of Americans relying on credit cards not for emergencies, but for everyday essentials, groceries, gas, rent, even medical bills. In your view, what does this shift reveal about the deeper structural problems inside the U.S. economy?
When people start using credit cards for basic necessities, that's not a spending issue, that's a structural issue. It tells you something fundamental is out of balance because credit cards were never designed to be a safety net for everyday life. They were meant for flexibility, not survival. What this shift really shows is that the cost structure of the American household has changed faster than its income structure. Housing, healthcare, childcare, food, these are the pillars of everyday life. And over the last decade, they've grown at a pace that wages simply haven't kept up with. When those essentials become unaffordable, people reach for whatever tool they have left. And the easiest tool is a credit card. But here's the deeper problem. When an economy forces people to borrow just to maintain a basic standard of living, you create long-term fragility. Households lose their resilience. A single unexpected bill, a car repair, a medical test can push them into a downward spiral. And when enough households reach that tipping point, it becomes a macroeconomic issue, not just a personal one. Another structural issue this reveals is lack of financial margin. Americans used to have more buffer savings, lower housing costs, affordable insurance. That buffer has eroded, and an economy where people don't have margin is an economy that can't absorb shocks. There's also a mindset shift happening. When people live paycheck to paycheck, they can't think beyond the next month. That limits mobility, ambition, and opportunity. People don't switch jobs, don't relocate for better work, don't start businesses. When daily survival becomes the priority, long-term progress takes a back seat. That's a structural drag on innovation. And innovation is the engine of American competitiveness. So what does this trend reveal? It tells us the US economy still grows, but not evenly. Productivity grows, corporate profits grow, technology advances, but the financial stability of the average household hasn't grown at the same pace. That imbalance creates pressure points, and pressure points eventually turn into breaking points if left unchecked.
Sir, delinquency rates on credit cards are rising fast, especially among younger Americans and lower income households. From your perspective, how serious is this trend, and what could happen if defaults continue climbing in the months ahead?
When delinquency rates start rising quickly, especially among younger Americans and lower income households, it's not just another data point, it's a canary in the coal mine. It signals that the financial stress people are carrying has reached a level where even minimum payments are becoming difficult. And once that happens, the situation tends to escalate faster than people expect. The seriousness of this trend comes from who is struggling, not just how many younger Americans are supposed to be the engine of future economic activity, buying homes, starting businesses, building careers. When they fall behind on credit cards early in life, it sets them back years. It affects credit scores, increases borrowing costs, and limits mobility. It creates a financial handicap before they even get started. For lower income households, rising delinquencies show they've exhausted every option. They've already cut back. They've already stretched their budgets. Missing payments is usually the last step before default. And once defaults rise, banks tighten lending standards. That restricts credit, which puts even more pressure on households that rely on it. It becomes a self-reinforcing cycle. If defaults continue climbing in the months ahead, you'll see a few things happen. First, banks will become more cautious. They'll increase reserves for potential losses. That slows down lending, especially to small businesses and weaker borrowers. Second, consumer spending will weaken because people who are behind on payments shift into crisis mode. They stop spending on anything that isn't essential. Retail, restaurants, travel, all of it feels the impact. The ripple effect can spread into the job market. When spending slows, businesses cut hiring or reduce hours. That creates even more financial strain, which leads to more delinquencies. It's a loop that's hard to break once it starts accelerating. And here's what many people overlook. A rise in delinquencies is not just a financial problem, it's a psychological one. When people fall behind, they often feel shame, fear, and uncertainty. That emotional weight affects decision making, productivity, and long term planning. An anxious society is not an innovative society. So, how serious is this trend?
It's very serious.
Because it tells us households aren't just stretched, they're starting to crack.
Sir, some analysts warn that rising credit card delinquencies could spill over into the broader financial system, from banks tightening lending to higher risks in consumer linked assets. Do you believe this strain could trigger a wider credit crunch in the USS?
When people hear phrases like credit crunch, they often imagine something dramatic and immediate, like the financial crisis in 2008. But the way stress builds in a modern consumer driven economy is usually much slower and quieter. It starts at the edges with households that are financially stretched and then it moves inward. Rising credit card delinquencies are one of those early edge signals. Could this spill over into the broader financial system? Yes, in a very real way. Not overnight, but through tightening behavior. Banks don't wait until losses hit their balance sheets to react. They adjust early. They raise lending standards, require higher credit scores, cut limits, and become more selective about who gets approved for loans. That's the first stage of a credit crunch. Not a collapse, but a contraction. When credit contracts, consumers have fewer tools to manage volatility. That means slower spending, which affects businesses, especially small ones that depend on everyday purchases. And when businesses feel pressure, they freeze hiring or cut hours. That's how something that begins as a consumer issue becomes an economic issue. Now, will this become a systemic crisis? I wouldn't use that word. The banking system today is more capitalized and better regulated than it was 15 years ago. But not a crisis doesn't mean not a problem. A widespread tightening of credit can still slow growth, raise unemployment, and reduce investment. Innovation suffers when capital becomes cautious. The real risk is psychological. When consumers feel lenders pulling back, they assume things are worse than they are. Confidence drops. And in an economy built heavily on confidence, markets, spending, investment, that mindset itself becomes part of the downturn. So, yes, rising delinquencies can trigger a broader credit tightening, not a dramatic collapse, but a gradual squeeze that limits opportunity and slows the economic engine. The question isn't whether the system will break, it's how much the strain will reduce its ability to move forward.
Sir, despite rising debt and higher delinquencies, consumer spending in the U.S. is still surprisingly strong. In your opinion, is this resilience a sign of real economic strength, or is it simply masking deeper financial vulnerabilities that could surface later?
When people look at strong consumer spending and assume it means the economy is perfectly healthy, they're missing the bigger story. Resilience can be real, but it can also be misleading. And in this moment, I think it's a mix of both. Yes, Americans are still spending, but the question is how they're sustaining that spending. If it's coming from wage growth and real productivity gains, that's healthy. If it's coming from savings depletion and rising credit balances, that's not resilience, that's pressure disguised as confidence. A lot of what we're seeing today is momentum. People are used to a certain lifestyle, and it doesn't change overnight. They continue spending because they're trying to maintain normalcy, even when the financial ground beneath them is shifting. That's understandable. People want stability, but it also creates a lag between when stress begins and when it shows up in spending data. Here's the deeper vulnerability. When households push past their limits to keep spending, they're borrowing future stability to pay for today's comfort. Eventually, that catches up. We've already seen savings rates fall to very low levels. We've seen credit card balances rise, and we've seen delinquencies increase across several age groups. Those signals usually show up before spending slows, not after. Another point people overlook is the psychological aspect. Americans are optimistic by nature. They believe things will get better, and that mindset drives consumption. But optimism, when paired with high debt, creates a fragile foundation. A small shock, a layoff, a medical bill, a rent increase, can quickly turn resilience into vulnerability. So, is strong spending a sign of strength? Partially, the US economy is flexible and innovative, and that helps keep demand alive. But is it also masking deeper issues? Absolutely. We're seeing both dynamics at once. The real test isn't how people spend during good times, it's how stable they are when something unexpected happens. Right now, too many households don't have enough margin to absorb that shock. And that's where the risk really lies.
Sir, many economists argue that the real danger isn't just the rising debt, but the long term habits it creates, relying on credit to fill income gaps, delaying savings, and pushing major life decisions further out. From your perspective, how could these behavioral shifts reshape the future of the American middle class?
When we talk about rising debt, most people focus on the numbers, but the numbers are only half the story. The real impact shows up in habits, the way people adapt, the compromises they make, and the expectations they slowly adjust downward. And those behavioral shifts over time can reshape an entire middle class. Using credit to fill income gaps may start as a temporary solution, but when it becomes routine, it rewires how people manage money. Instead of planning ahead, they react to the moment. Instead of saving for emergencies, they rely on borrowed money to handle them. It moves families from a proactive posture to a defensive one. And once people are forced into defense for long enough, it becomes a mindset, not just a situation. Delayed savings is another major shift. When people can't save consistently, they lose one of the most important advantages of the American system: compounding. Wealth in the US has always been built on long-term assets, homes, retirement accounts, investments. If the middle class can't participate in that cycle early, they fall behind not by inches, but by miles. And catching up becomes nearly impossible. Then there are the big life decisions: buying a home, starting a business, going back to school, having kids. These decisions require confidence in the future. But if people feel financially unstable, they push them further and further out. And when a society delays its major life choices long enough, it reshapes everything from entrepreneurship to demographics to the long-term growth rate of the economy. So how does this change the future of the American middle class? It compresses it. It reduces mobility. It narrows the path upward. A middle class that relies on credit instead of savings is a middle class losing its ability to build wealth. Resilience becomes thinner. Opportunity becomes rarer. The American middle class thrives when it has margin, financial, psychological, and aspirational. When that margin shrinks, the middle class doesn't disappear, but it becomes more fragile. And a fragile middle class leads to a more fragile country.
Sir, with debt rising, savings falling, and households under growing pressure, many Americans are asking the same question: what needs to change for the country to move toward a healthier financial future? From your perspective, where does the real reset begin?
When people talk about fixing the financial future of the United States, they often jump straight to big, dramatic solutions, massive policy shifts, sweeping economic reforms. But real resets rarely start at the top. They start where pressure is highest, the household level. The first thing that needs to change is margin. A healthy economy depends on people having space, financial, and psychological. When households live with no cushion, everything becomes reactive. They make short-term decisions because they don't have the runway for long-term thinking. Rebuilding margin means increasing incomes in real terms, reducing unavoidable costs, and giving families the breathing room they've lost over the last decade. Second, we need to restore confidence. Not the markets are up kind of confidence, but the kind that comes from stability, the belief that hard work leads to progress, that opportunities are within reach, that the system isn't stacked against you. Confidence is fuel. Without it, people don't invest, don't innovate, don't take chances. Third, we have to rethink the role of consumer debt. Credit can be a powerful tool, but it was never meant to be the backbone of middle-class life. When credit fills income gaps, it creates fragility. When it fuels investment, it creates strength. The shift may sound small, but the outcome is huge. And finally, the reset begins with long-term thinking. I say this all the time. Long-term thinking isn't just a business strategy, it's a life strategy. The US economy has incredible long-term potential. Innovation, entrepreneurship, technology, these are unmatched advantages. But households need to be stable enough to participate in that future, not just survive it. So where does the real reset begin? It begins with rebuilding the foundation. Stronger incomes, lower essential costs, smarter use of credit, and a return to long-term decision making. If we get those elements right, the American financial story can shift from strain to strength. And when the middle class is strong, the country is strong.
Thank you for your honesty and your clarity. In a moment when millions of Americans are trying to make sense of rising debt, shrinking savings, and a future that feels more uncertain than ever, your perspective gives us something rare: a calm understanding of the bigger picture. This conversation reminds us of one thing: the numbers matter, but the people behind those numbers matter even more. And the future of the American household will shape the future of America itself. Thank you for your time.